Momentum delivered solid interim results across all business units. This as management interventions enhanced the new business mix. The group said results were further aided by higher market returns and favorable yield curve shifts over the period. Momentum CEO Jeanette Marias joins us now with greater insight on the performance. Thank you so much for your time, Jeanette. The first line that actually jumped out at me, and I see that we had it in the intro, is interventions to enhance new business mix. And that's really one of the factors that you credit your excellent performance to. Does that mean a favorable product mix when it comes to new business with higher margins?
Well, yes, so that's a fantastic question. Thank you very much, Zanati, for asking that. If you look overall at our sales numbers, you might be disappointed and say, it stayed exactly the same as what it was last year. Last year, it was just over 39 billion. This time, it was 38.9 billion. So basically a flat rate. But I think what is hidden by that is the fact that the businesses on our life license that we look at when we do that report is actually Momentum Retail, which really is our life insurance and savings businesses in the affluent market, Momentum Investments, Metropolitan, Momentum Corporate, which is our pension funds and employee benefits business, and then our business across Africa. And if you then look at the individual businesses, that number or that picture is quite different. Momentum Retail in Myriad, which is our life insurance product, had 9% increase in sales. Momentum Investments, off a very high base, 6%, Metropolitan 2%, and Africa 19% increase in sales. The only one that have actually detracted from that number slightly was Momentum Corporate, which actually had quite a bit of a tougher year with less sales done, in the year. So on average, it looked like we had no move, but actually in all of our retail businesses, we did really, really well. Now, business mix referred to the type of product you sell. I'll give you an example. In Metropolitan, for instance, we have savings products, we have funeral business, we have annuities. So it depends on the type of product you sell. And when we talk about business mix that have helped with better quality business or with more profitable business, some products are just more profitable than others. There's not a lot of profit in a recurring premium savings product, for instance, because it's a small premium and it's not really a client that can afford a massive profit margin in there, but you want to offer the product. And I guess often in terms of your profitability, it's important to focus on selling more of the product where there's more of a margin for yourself in there.
It's quite interesting that you also go to Momentum Corporate that you say had maybe a little bit of a tougher year. Is there a specific reason for that? Because I think if I remember one of the other insurance companies, there was also something of a similar narrative.
Now, what's interesting in Momentum Corporate is that our sales weren't as great as it was, the same period a year ago. But what's important is that the year ago period, the first half of our previous financial year was actually a record sales year for Momentum Corporate. And in fact, in that time, we landed two very, very big pension funds, which didn't repeat. So it's still great sales, but it just doesn't compare with the similar period, a year ago. So I think that's one thing. But it is important to note that in the pension funds and employee benefits market, when the economy struggles, that market is hit first. Because companies start to get to a point where they say, we can't afford, let's say, to offer risk life insurance for our employees. So there's definitely an impact in a market like that during times like this. But what is important to note is that although we had flat sales, not the same happened, of course, for our profits, for our earnings. Momentum Corporate, in this period, delivered 850 million of earnings, which is by far the best 6 months it's had in its history. So these two things don't often go hand in hand. Sales doesn't necessarily give you any indication of the earnings that you're going to generate over the same period.
And really quite a lot of things that will eventually inform the level of growth of that bottom line. And as we're talking about this, because I also know that you have been on a cost optimization journey, on what part of that journey are you in?
Well, so we announced it last year at the beginning of our financial year. So we're 6 months into this process.
Okay.
And the first probably 3 or 4 months was actually spending on doing a very deep dive analysis on every single pocket of costs that we have in our business. Now, to put it in perspective, we're a business that on an annual basis, our cost base is about 12 billion.
Yeah.
Now, if you want to save 10% of that is 1.2 billion. It's not that easy in today's day, to take that kind of money out of your bottom line. But what is also interesting is by the time you spend 12 billion rand a year, there are a lot of things you can do smarter. There are a lot of duplication happening. And I promise you, we've gone into things like, what is our travel policy? Can people travel business class? What kind of hotel can they stay in? We looked at procurement. We looked at our technology, long-term technology contracts we have. Those are difficult because not only are they dollar priced? So you also have the fluctuations, of currencies there.
Yeah.
But those are very, very big contracts. So we have left no stone unturned. And through that process, we actually identified 1 billion rand that we think we could actually get cut out of our business without harming our business in any way. Duplication, procurement, and actually just things that maybe is not the best way to spend our money.
This is very interesting, particularly the things that you also highlight in terms of where you've trimmed the fat. I think, Jeanette, you should be advising government in this cost-cutting program. Well, let's get into your persistency experience. I saw that, of course, one of the drivers of earnings growth is improved persistency experience. Is this a sign of the consumer turning a corner in financial health?
Unfortunately, I can't say yes.
Yeah.
So the biggest improvement in persistency we had was in Metropolitan. And I mean, that is the part of society that is often hardest hit, by economy, by high interest rates, by price increases and so forth. And there I almost want to say that unfortunately, what we see is not necessarily an indication that our consumers in a better space. It is more actually our own actions to, I would call it, score our own goal.
Okay.
And let me explain very briefly. In Metropolitan, we were in a space where there was actually quite a few things in our business that we needed to address and turn around. And the greatest impact that we've had on this persistency change is actually two things. The first one is what we call quality of business. Make very sure by the time you write a policy that it is with a real client who can afford it and want it and is committed to it. So advice play quite a big role there.
Okay.
The second one is quite technical, but it's an amazing, impact that it's had. In the past, when an advisor wrote a policy for a client, by the time he submitted all the documentation, we immediately paid out the commission on that policy.
Okay.
However, a month, 2 months go past, and we call it a non-taken up NTU. The client never even paid the first premium. By then, we've had all the cost. The advisor might have even left us. We've got no way to recoup that cost. And at the same time, the client is actually never taking up the policy. So we changed that by changing the way in which we pay commission. We now only pay commission on receipt of first premium. So at least we know it's a real client. We know the client is committed to the policy. They want it and they actually have the money to pay.
Yeah.
So sometimes you can have your own internal rules that can actually, be to the detriment of your business over time. And we try to sort that out.
It's quite interesting because I think that commission policy has also been implemented at Virgin Active, or they're about to implement it, but I've heard some news of that being done there. So quite an interesting one there. As we close off the conversation, Jeanette, as we're talking about the consumer, of course, consumers have been under strain, and so they've needed to withdraw from their two-pot retirement savings. How would you characterize the momentum of the two-pot withdrawals that you've seen?
Well, so firstly, I'm very proud to say that we were ready on the 1st of September. Metropolitan actually paid out the very first two-pot claim.
Yeah.
So we spent a lot of time and actually a lot of capital on technology to be able to be ready. I think we did foresee that the volume of claims was probably going to be quite detrimental to the business if we weren't ready with systems to help us with that. And we were quite ready, but you're never 100% ready. What is interesting is that from the 1st of September, when two-pot, became a reality, until the end of 28 February now, 2 weeks ago, we got valid claims of just over 200,000 number of claims, and the amount was round about 4.2 billion rand. Now, remember, that's across quite a few of our businesses, across Momentum Investments, Momentum Retail, Momentum Corporate, where we administer very big pension funds. They were actually the hardest hit, and of course also across Metropolitan. The volumes were astounding. Those businesses went from 3,000 calls a day to 40,000 calls a day. So it really caused quite a lot of disruption. Most of those we did manage to handle, through kind of technology. But I think what is important, two things. The one is it was still less than what we anticipated. So we were quite pleasantly surprised. We thought that we might have had to pay out more. It was a little bit less than what we anticipated. But sadly, in the last 2 weeks, since the 1st of March, when of course people could come back for a second claim, we have seen just under 40,000 claims in the 2 weeks that has been submitted. But here's the sad part. 83% of clients who claimed in the first 2 weeks also claimed in the first cycle. And that is such, in fact, I think devastating in the long run for our economy and for people's ability to retire with dignity. Because not only are they now dipping into the money that they saved for later, they also tend to be in their kind of late 40s, early 50s, which means they don't have a lot of time left to make up for the money that they're now withdrawing. And that for us is a very concerning number. Not so much the amount, because of course now the amounts are much smaller, because the second pot hasn't really yet, kind of grown. But the fact that 83% of those people have been here a couple of months ago and they're back at the door again to withdraw the maximum that they can. And I think in the long run, that is something that we do worry about quite a lot.
It's quite concerning, Jeanette, and I guess it also speaks to what you said earlier, that you actually can't say that the consumer has turned a corner in terms of their financial position and their financial health. So, of course, we do still need that economic growth to come in so that it can lift everyone up. Thank you so much for your time and giving us that insight, Jeanette. Much appreciated. That was Jeanette Marias, CEO for Momentum.